how to identify or estimate the value and adequate return on a stock that we've already determined met our criteria for quality. So one of the stocks that we realized met our criteria for quality was Disney, symbol DIS. Okay, so we're gonna go to MSN Money. We're gonna put in our quote DIS, and so it's trading at 55.61. We're gonna put that in right here. As of today is 2 minus 18 minus 1 3. Okay, so the first thing we want is to look at their earnings. So we're gonna go to 10-year summary. And here's their earnings per share. So we want the most recent 3 years and then the oldest 3 years. So we're going to put these in 313, 252, and 203. We're going to put those in right here. 315, 252, and 203. Okay. And then we're going to go back and do the 7 years earlier, which is a 119, 111, and 65. Okay, then we also want the dividend yield. Let's go back to quote. I should have got that when I was on the quote page. Dividend yield is 1.35. So I'm going to put that in right here. 1.35. Okay, and if I want to compare the 3-year average that I got here, which is the calculation of the average of these three, compare that to their trailing 12 months and to their earnings estimate to give me some idea, I'm going to go to income statement. I'm going to go to interim, and then I'm going to add the last 4 quarters, which is going to be this basic EPS. So I'm going to add that up. 0.78 plus 0.69 plus 1.02 plus 64 cents equals 313. That's these 4 right here. So I'm going to put that right here, 313. And then I'm going to put in the earnings estimate. So I'm going to click on earnings. And the estimate for fiscal year ending 9/13 is the average estimate out of 26 analysts, the low being 331, the high 366, the average is 343. So I'm going to put that on there too. Earnings estimate is 343. Okay. And we're going to start with 257. And then we're going to decide what multiple to use for Disney. So we want to look at key ratios, 10-year summary, and we see that there's no real reason to lower the PE on Disney. It's not historically traded consistently below 15. Let's see if there's a reason to raise the earnings estimate. Well, one, we're in a low interest rate environment, so that would be one reason to raise the estimate. But let's look at if that's 11% earnings growth is pretty good. It's a little bit better than average. Average would be like 8 to 10. So let's put a 17 multiple on Disney. Why? The reason is low interest rates and strong growth. Okay, so that gives us an intrinsic value of 43.69, looking at the 3-year average at 257. But you look at last year, Last year it was 313 and the estimate is 343, so I think we could still be pretty conservative with it. Put an estimate of 3 on this. It gives it a price of 51. It's still a little bit expensive, so I think we'll pass on Disney. Let's go to Schlumberger. Oops. Let's go to Schlumberger for our next one. Symbol SLB. Okay, and the price of Schlumberger, so I'm going to go back here to MSN. I'm going to click on SLB. And it's at 80.03. And the dividend yield is 1.56. Okay, so now let's go for our earnings. I'm going to click on 10-year summary. And we're going to add these in 4.06, 347, and 337. This is actually 2012. And this is 4.06, 3.47, 3.37. Okay, and then 7 years ago we're at 543, so that should be 2005, 2004, 2003. And those earnings were 181, 85 cents, and 34 cents. Okay, so that has an earnings growth of 20%. That's pretty good. That's very good. Actually, let me move this so that we're at G. Okay. So let's look at the trailing 12 months. Let's go to the income statement. Put on interim. We're going to scroll down here and we're going to add up these 4 right here. $1.03 plus 1.07 plus 1.05 plus 0.97, 412. So I put that right there. And then the earnings estimate, I'm going to click on earnings. And it's 474 for fiscal year ending 12/13. 474. But notice there's a pretty big gap here, so we better be pretty conservative on this one. 28 analysts, and they're kind of all over the map here, so 474 is the estimate. Okay, so let's start with Graham's number, 3.63. And let's see what we're going to use for a multiple here. So let's go to key ratios. 10-year summary. Okay, see, there's no real reason to go below 15, but let's see if we should go above 15. Earnings growth is pretty strong, and interest rates are low, so let's say we might use a 18 or 19 here. Let's start with 18. We'll start being a little bit conservative, way off. And the reason that we're making that adjustment is low interest rates and strong growth. Okay. This thing's moving on me. Okay, so let's try 19. Still off. And let's adjust this up to maybe 4. Still a little expensive, even using a 19 multiple and a earnings estimate of $4. It's a little on the expensive side. Let's take a look at Exxon. Oops, XOM. Symbol XOM. Okay, so let's put in our symbol here. Price is 88.36, and the earnings yield is 258. Okay, let's look at our earnings history. 10-year summary. 970, 842, and 622. So I'm going to put that right here. 970, 842, and 622. And then 7 years ago, 571, 389, and 315. Okay, so that's earnings growth at 9.68%. 3-year average of 811. Let's look at the trailing 12 months by going to the income statement. Hit interim. Go down. So we're going to add these up. 219 plus 2.08 plus 342 plus 2, 969. This is 9.69. And the estimate, the estimate for earnings is 791. 16 analysts between a 621 and 885. It's for Exxon, 791. Earnings estimate is a 7.91. So I better not change that 811. Okay, so let's see what kind of multiple we should be using for Exxon. Let's look at our key ratios. Ten-year summary. Okay, now here's a good reason to lower our earnings estimate, because it's consistent, with the exception of this 1 year, it's consistently been around 9, 10. So let's change this to 10. And the reason is historically low multiple. Okay, let's look at our earnings growth. Zero. Last 5 years and 0. So not a real compelling reason to raise that PE above a 10 for average growth. Interest rates are a little bit low, but I don't know, when you have analysts estimating a 791, I'd probably keep it at this 811. So far those three are looking a little bit pricey at this point. We'd probably want to wait till they came off a little bit. But that's how you would do the homework on that. And hopefully this has been helpful to you.